Have you ever wondered what happens when a government, much like a household, has to pay more on its borrowings? The cost of running a country is immense, and governments often relying on borrowing to fund everything from infrastructure projects to public services. When the cost of that borrowing changes, it can send ripples through the entire economy. Yes, interest rate hikes absolutely affect government debt servicing. When a central bank raises its benchmark interest rate, it increases the cost of borrowing across the economy, and this directly translates into higher interest payments for governments on their outstanding debt. The primary mechanism behind this impact lies in how governments finance themselves. They issue bonds, which are essentially loans from investors. These bonds have a coupon rate, which is the interest paid, and a maturity date. When interest rates rise, newly issued bonds must offer higher coupon rates to attract investors. Furthermore, as existing debt matures, it must be refinanced or rolled over with new bonds that reflected these now higher market interest rates. This means that even if a government is not taking on new debt, its average borrowing cost will increase over time as older, lower-rate debt is replaced. For governments, this means that a larger portion of the national budget must be allocated to paying interest on their debt. This can lead to difficult choices, potentially reducing funds available for other critical areas like education, healthcare, defense, or infrastructure investment. Governments may face pressure to either increase taxes, cut spending in other areas, or borrow even more, creating a cycle that can strain public finances. Understanding this dynamic is crucial for grasping what economists refer to as debt sustainability. A key indicator here is the debt to gross domestic product ratio, or DGP ratio, which measures a country's debt relative to its economic output. A higher DGP ratio means even a small rise in interest rates can have a disproportionately larger effect on the total interest bill, making the debt burden heavier. Central banks and fiscal authorities often coordinate, or at least consider, the implications of their policies on this crucial fiscal stability. Ultimately, recognizing how monetary policy, in the form of interest rate adjustments, influences government borrowing costs provides a clearer picture of a nation's financial health and its capacity to fund future growth and public welfare. It highlights the intricate link between central bank decisions and a government's fiscal headroom, which is its ability to spend without endangering its long-term financial stability.